The 2008 financial crisis was caused by greedy bankers who made reckless decisions. What if I told you that the crisis was actually the most successful wealth transfer operation in history, designed to consolidate elite control rather than punish elite failures? This sounds logical because we see bank failures, executive resignations, and regulatory responses as evidence that the system held wrongdoers accountable. But there's something that doesn't add up about why the biggest banks became even bigger after supposedly failing, and why the people who caused the crisis ended up wealthier than before. Everyone knows the financial crisis story. Banks made bad mortgage loans, packaged them into complex securities, and sold them to unsuspecting investors until the whole system collapsed. Why did the government rescue the institutions that created the crisis while letting ordinary people lose their homes and jobs? This sounds like accountability, because we see congressional hearings, regulatory investigations, and promises of reform in response to public outrage. But there's something that doesn't quite fit about why the bailouts made the financial sector more powerful rather than less powerful. The crisis capture mechanism works by creating emergencies that justify transferring public resources to private interests while presenting these transfers as necessary for economic stability. While ordinary citizens bear the cost through foreclosures, unemployment, and austerity measures, financial elites receive bailouts, quantitative easing, and policy support. If this kind of crisis exploitation, disguised as crisis management, interests you, subscribe to Prof. John Explained, and share this video with someone who's been told that the 2008 bailouts saved the economy. They need to understand how financial crises actually strengthen rather than weaken elite control. The system creates fundamentally different relationships with financial crises depending on your position in the economic hierarchy. When we talk about financial crisis, we mean completely different experiences for different groups of people. For financial elites, crises represent opportunities for consolidation, government support, and elimination of competitors. They benefit from bailouts, asset purchases, and regulatory capture that emerges from crisis response policies. For ordinary citizens, crises mean job losses, foreclosures, reduced public services, and increased debt burdens, while being told that these sacrifices are necessary for economic recovery. Think about what happened to your community during the 2008 crisis. Who received help immediately and who was told to wait for recovery to trickle down. This explains something curious about crisis response. The same policies that claim to stabilize the economy often transfer wealth from crisis victims to crisis creators, rewarding failure while punishing success. The difference isn't about emergency response versus normal policy. It creates systematically different outcomes where crisis becomes a mechanism for accelerated wealth concentration rather than economic correction. But here's where it gets interesting. The crisis capture mechanism doesn't just exploit existing emergencies. It actually creates the conditions that make crises both inevitable and profitable for those positioned to benefit from them. Consider how the crisis was constructed before it occurred. Financial institutions spent decades deregulating their industries, creating complex instruments that obscured risk, and establishing interconnections that would make their failure catastrophic for the broader economy. This creates what economists call moral hazard on steroids, where institutions can take unlimited risks, knowing that success brings private profits, while failure brings public bailouts. The preparation phase ensures that when crisis arrives, the institutions that created it have become too important to fail, making their rescue appear necessary rather than optional. Meanwhile, the complexity of financial instruments and interconnections makes it nearly impossible for regulators or the public to understand what actually happened or who bears responsibility. The pre-crisis construction also involves what political scientists call regulatory capture acceleration. Financial institutions invest heavily in relationships with regulators, politicians, and policy intellectuals who will advocate for industry-friendly policies. This regulatory relationship building ensures that when crisis occurs, the same people who help create the conditions for crisis are positioned as experts who understand how to resolve it. The regulatory capture creates policy feedback loops where crisis response reinforces the power of institutions that caused the crisis rather than challenging their influence. But the crisis capture mechanism becomes even more sophisticated when we examine how it handles the narrative around crisis causation and crisis response. The official story focuses on individual bad actors, regulatory failures, and market excesses rather than examining how the crisis serves specific interests and achieves specific outcomes. This narrative displacement allows the same institutions that engineered the crisis to present themselves as victims of circumstances beyond their control, while positioning themselves as essential partners in crisis resolution. The story becomes about saving the economy rather than about wealth transfer, making the bailouts appear altruistic rather than self-serving. The narrative management also operates through what media scholars call crisis framing control. Financial institutions and their allies shape how news organizations, politicians, and academics understand and discuss the crisis. This framing control ensures that acceptable solutions to the crisis remain within boundaries that serve financial industry interests while marginalizing alternatives that might threaten industry power. When the crisis hit, the speed and scale of the response revealed the true power relationships within the political and economic system. Do you notice how quickly trillions became available for bank bailouts, while stimulus for ordinary citizens faced months of political debate? The crisis capture mechanism also exploits what political scientists call disaster capitalism. Crises create windows of opportunity for implementing policies that will be politically impossible under normal circumstances. The urgency of crisis response bypasses normal democratic processes, allowing policies to be implemented with minimal public input or congressional oversight. This emergency decision-making ensures that crisis response serves elite interests while being presented as technical necessity rather than political choice. The disaster capitalism dynamic also creates what economists call policy ratchet effects. Policies implemented during crisis emergencies typically don't get reversed when the emergency passes, creating permanent changes that benefit crisis beneficiaries. The emergency justification allows radical policy changes to be implemented without normal political debate, while their permanence ensures lasting benefits for the interests they serve. But there's something even more insidious about how the crisis capture mechanism affects the relationship between private profits and public costs. The bailout structure ensured that financial institutions could keep their profits from the bubble while transferring their losses to taxpayers, creating a privatized gains, socialized losses dynamic. This wealth transfer happened through multiple channels: direct bailouts, quantitative easing that inflated asset prices, and zero interest rate policies that subsidized financial sector profits. Meanwhile, the austerity measures implemented to pay for these bailouts reduced public spending on programs that benefit ordinary citizens, creating a double transfer from public to private wealth. The result is that crisis becomes a mechanism for accelerating wealth concentration while being presented as economic necessity rather than political redistribution. The wealth transfer mechanisms also operate through what economists call asset price manipulation. Central bank policies implemented during crisis recovery systematically inflate asset prices that benefit wealthy investors while imposing inflation costs on ordinary consumers. These policies transfer wealth from people who spend most of their income on goods and services to people who own financial assets and real estate that appreciate due to monetary policy. The asset price inflation appears to be an unintended consequence of necessary economic policies rather than a deliberate wealth transfer mechanism designed to benefit crisis beneficiaries. The crisis capture mechanism also creates what economists call systemic blackmail. Once institutions become large and interconnected enough, they can threaten economic collapse to secure favorable treatment from regulators and policymakers. This systemic importance doesn't emerge naturally from market forces. It gets constructed deliberately through mergers, acquisitions, and regulatory capture that create institutions that are genuinely too big to fail. The blackmail works because the threat of economic collapse is real, even though the institutions making the threat are the ones who created the conditions that make collapse possible. This creates a feedback loop where institutions become larger and more interconnected with each crisis, making future crises both more likely and more profitable for the institutions that cause them. The systemic blackmail also operates through what political economists call interconnection weaponization. Financial institutions deliberately create complex webs of relationships with other institutions, governments, and pension funds that make their failure catastrophic for many innocent parties. This interconnection strategy ensures that rescuing the institution appears to serve broad social interests rather than narrow institutional interests, making opposition to rescue appear antisocial rather than just anti-elite. Can you think of any other industry where failure results in government rewards rather than market consequences? The crisis capture mechanism becomes particularly effective when it intersects with what political scientists call the legitimacy trap. The more severe the crisis, the more urgent the need for response, and the less time available for democratic deliberation. Citizens face a choice between accepting elite solutions or risking economic collapse, making it politically impossible to reject bailouts, even when they clearly serve elite rather than public interests. This forced choice ensures that crisis response strengthens rather than challenges the power of the institutions that created the crisis, because any alternative appears to threaten economic stability. The legitimacy trap also creates what political psychologists call crisis Stockholm syndrome. The more dependent people become on institutions that threaten their welfare, the more necessary the protection of those institutions appears to become. People begin to identify with institutions that harm them because protecting these institutions appears necessary for their own survival, even when the harm comes from the institutions themselves. But perhaps the most sophisticated aspect of the crisis capture mechanism is how it handles the relationship between short-term emergency measures and long-term structural changes. Policies implemented during crisis get presented as temporary emergency measures, but they typically become permanent features of the economic system. Quantitative easing, zero interest rates, and too-big-to-fail protections all began as crisis responses, but evolved into ongoing policy frameworks that systematically benefit financial elites. The temporary nature of these policies makes them easier to implement politically, while their permanent effects ensure lasting benefits for the interests they serve. This temporal bait and switch allows radical changes to be implemented without democratic mandate, while being presented as prudent crisis management. The temporal manipulation also operates through what political scientists call crisis periodization. The crisis gets defined as a discrete event, with clear beginning and ending points, obscuring how crisis response creates ongoing structural changes. This periodization allows policymakers to claim that emergency measures ended with the crisis, while ignoring how these measures created permanent institutional changes that serve elite interests. The crisis capture mechanism also exploits what behavioral economists call loss aversion in political psychology. The fear of losing what people already have makes them more willing to accept unfair solutions than to risk potential catastrophe. Politicians and media emphasize the catastrophic consequences of not rescuing failing institutions while minimizing the costs and consequences of rescue policies. This fear-based framing ensures that public attention focuses on avoiding worst-case scenarios rather than evaluating whether rescue policies actually serve public interests. The psychological manipulation makes it politically impossible to hold institutions accountable because accountability appears to threaten economic survival. The loss aversion manipulation also creates what psychologists call sacrifice rationalization. People who bear the cost of crisis response convince themselves that their sacrifices serve broader social good rather than narrow elite interests. This rationalization prevents people from recognizing that they're being exploited while ensuring their continued support for policies that harm their interests. Have you ever wondered why financial crises always seem to make the financial sector more powerful rather than less powerful? The system also creates what political economists call regulatory Stockholm syndrome. The more dependent the economy becomes on institutions that are too big to fail, the more necessary their protection appears to become. Regulators develop relationships with the institutions they oversee, making it psychologically and professionally difficult to take actions that might threaten these institutions, even when such actions would serve broader public interests. This regulatory capture ensures that crisis response serves the interests of the captured institutions, rather than the public interests that regulators are supposed to protect. The regulatory Stockholm syndrome also operates through what institutional scholars call bureaucratic clientelism. Regulatory agencies develop institutional interests that align with the institutions they regulate, rather than with the public they supposedly serve. This clientelistic relationship ensures that regulatory agencies become advocates for industry interests rather than watchdogs protecting public interests. But there's yet another dimension that makes the crisis capture mechanism particularly effective at consolidating rather than redistributing economic power. The complexity of modern finance makes it nearly impossible for ordinary citizens or even most politicians to understand what actually happened during the crisis or evaluate whether response policies serve public interests. This complexity advantage allows financial institutions to present self-serving policies as technical necessities while making it difficult for critics to offer alternative solutions. The expertise asymmetry ensures that crisis response gets dominated by the same people who created the crisis because they appear to be the only ones who understand the system well enough to fix it. The complexity barrier also creates what political scientists call technocratic insulation. Policy decisions get removed from democratic control because they appear to require technical expertise that ordinary citizens lack. This technocratic framing allows elite preferences to be implemented without democratic mandate, while being presented as objective technical necessities rather than subjective political choices. Consider how the crisis capture mechanism handles the relationship between individual accountability and systemic responsibility. The focus on prosecuting individual wrongdoers distracts attention from examining how the crisis served institutional interests and achieved institutional objectives. Even when individual executives face consequences, the institutions they represent emerge from crisis stronger and more protected than before. This individualization of responsibility allows systematic wealth transfer to continue while providing the appearance of accountability and justice. The individualization strategy also operates through what criminologists call scapegoating dynamics. A few high-profile individuals get blamed for systemic problems, while the institutional structures that created those problems remain unchanged. This scapegoating allows institutions to claim they've addressed wrongdoing while preserving the systems that enabled wrongdoing in the first place. The crisis capture mechanism also creates what economists call disaster consolidation. Smaller institutions that cannot threaten systemic collapse get allowed to fail, while their assets get acquired by larger institutions that are too important to fail. This selective rescue process increases market concentration while being presented as market discipline, creating a system where failure leads to consolidation rather than competition. The consolidation process ensures that each crisis makes a financial system more rather than less likely to require rescue in future crises, creating a ratchet effect toward increasing systemic importance. The disaster consolidation also operates through what antitrust scholars call crisis merger facilitation. Regulatory agencies approve mergers during crises that would be blocked under normal circumstances, allowing large institutions to acquire distressed competitors at bargain prices. This merger facilitation increases market concentration while being justified as emergency response rather than recognized as deliberate industrial policy that serves large institution interests. But perhaps the most remarkable aspect of the crisis capture mechanism is how it convinces people that the institutions that cause the crisis are essential for preventing future crises. The bailout process creates dependencies, where the broader economy relies on the continued health of the institutions that threaten its stability, making their protection appear necessary for everyone's welfare. This dependency ensures that future crises will require even larger bailouts, because the institutions have become more rather than less systemically important. The mechanism ultimately works because it transforms crisis from a threat to elite power into an opportunity for elite consolidation, ensuring that economic instability strengthens rather than weakens the power of those who create instability. But understanding the crisis capture mechanism doesn't necessarily lead to fatalism about elite power. Rather, it suggests the importance of recognizing how crises can be used to accelerate rather than correct economic inequality. The mechanism continues because it serves essential functions for financial elites while appearing to serve broader economic stability, making it difficult to challenge without appearing to threaten economic security. Understanding how crisis capture works reveals that preventing future wealth transfers might require changing the structure of financial institutions before the next crisis, rather than trying to reform crisis response after institutions have already become too big to fail. The crisis capture cycle represents one of the most successful mechanisms for consolidating economic power while maintaining democratic legitimacy, ensuring that each crisis strengthens rather than challenges the system that creates crises. The cycle also reveals how modern capitalism has developed sophisticated mechanisms for converting social disasters into private opportunities, while maintaining public support through fear-based messaging and complexity barriers. Understanding these dynamics doesn't provide easy solutions, but it does suggest that effective response to elite power might require anticipating and preparing for crisis exploitation rather than responding to it after it occurs. The crisis capture mechanism ultimately reveals that in modern financial systems, stability and instability both serve elite interests. Stability maintains existing wealth, while instability provides opportunities for wealth consolidation. This dual functionality explains why financial crises continue to occur despite sophisticated regulatory systems designed to prevent them, and why crisis responses consistently strengthen rather than reform the institutions that create crises. The pattern suggests that what appears to be system failure might actually be system success, from the perspective of those positioned to benefit from crisis dynamics. Hit subscribe if you want more analysis of how economic policies that appear to serve public stability actually serve private wealth accumulation. And share this with someone who's been told that financial bailouts were necessary to save the economy.